Good morning. DSCR loans versus conventional mortgages. Which one helps you scale faster as an investor? Well, for real estate investors focused on growth, financing is not just about interest rates, it's about scalability. And the loan product you choose determines how quickly you can acquire properties, preserve liquidity, and expand your portfolio. And two of the most common options are DSCR loans and conventional mortgages, but they're built for very different investor strategies. And as a mortgage broker working with investors across Texas and nationwide, I see firsthand why experienced investors increasingly favor DSCR loans when scaling just beyond one or two properties. Now, understanding conventional mortgages. Conventional mortgages were designed primarily for owner occupants and small scale investors. And approval hinges on personal income, DTI ratios, tax returns, and W 2s. So here's some of the advantages of conventional loans: lower interest rates in many cases, and long-term fixed rate options. And it's also a familiar underwriting process to what you're used to doing or used to understanding. And here are some of the limitations for investors. So you're going to have strict debt to income ratio caps, and there's heavy documentation requirements. And there's also loan limits per borrower. And it's also a difficult approval for self-employed investors. So conventional loans often work well for a first or second rental, but growth slows quickly once personal income becomes the bottleneck for your growth. And what makes DSCR loans different? Well, debt service coverage ratio, or DSCR loans, focus on the property, not the borrower's personal income. And approval is based on whether rental income covers the mortgage payment. And here's why DSCR loans are built for scale. There's no personal income verification, which means there's no DTI constraints. And there's an unlimited number of financed properties. And traditionally, there's faster underwriting and closings because you don't have to prove income. And it's great for people who want to invest in an LLC as well as portfolio investors. If the property cash flow works, the loan works, even if your tax returns show aggressive write-offs. So which loan's going to help you scale faster in the long term? If your goal is portfolio growth, DSCR loans are almost always going to outperform conventional financing. And they allow investors to reinvest capital instead of paying down debt aggressively. Helps them acquire multiple properties even simultaneously. And it helps separate personal finances from investment properties, which also means that you can move quickly in competitive markets. Now, don't get me wrong, conventional loans still have a place, particularly for primary residences or first-time rentals, but they're not designed for rapid expansion. And here's the broker insight, the real advantage. The real power comes from strategic loan stacking, and many investors start with conventional loans, then transition into DSCR financing once income or property count starts to become restrictive. And in Medallion funds, we help investors structure financing that aligns with long-term growth, not just a single transaction. And here's the final takeaway. Scaling a real estate portfolio requires financing that keeps up with your ambition. DSCR loans remove personal income ceilings and unlock faster, cleaner growth for serious investors. Now, if you're looking to scale efficiently, the right loan structure matters more than the rate. That is it for the day. Please visit my website, billrapponline.com. You can get some free resources, check out rate pricing, and schedule a consultation there as well. Thank you for your time. Have a good day.